I'm Jim Jubak, and welcome to my YouTube video for March 16th. It's spring here in New York, at least momentarily. I went out walking in the park yesterday and I saw my first crocus, my first park daffodils. The mourning doves are out going cooing like crazy. It's bright and sunny, which is good because the Fed is a little depressed, so we'll talk about that in a minute. So anyway, if you like this video, thumbs up. Please subscribe to my YouTube channel. That'll let you know when we're doing videos. If you want to see more of my written stuff and 3 portfolios for 1 year long-term and then dividends, go to my jubakpicks.com site. That's free. If you want 6 portfolios instead of 3, which adds ETFs and what are those called? Options. Go to my paid site. That's jubakam.com, and all that's down below. We're doing a very interesting special report for subscribers on Jubak AM right now on the odds of the coming recession and how to position a portfolio for that. So you might want to check that out by subscribing. So today's talk is the Fed gets depressed. Now today was the meeting of the Open Market Committee. That's the one that sets interest rates. And we got, as expected, a 25 basis point increase. It was so expected that it has, as far as I can tell, pretty much no effect on the market. But today was also a dot plot day. That's the day that the Fed releases its new projections on its thinking about interest rates in the future and inflation in the future and GDP growth. And that was, well, depressing. And I think one of the reasons the market was up ahead of the Fed meeting and then down after the Fed meeting. And I think that one of the reasons for that was that the Fed's dot plot was really pretty, well, grim. The dot plot is basically a compilation of the opinions from the presidents of the various Federal Reserve and Federal Reserve officials, and then published. And here's what is table 1 from today's Federal Reserve site. And I want to focus on what's really important is the median change. And here, GDP. So today's reading is 2.8% GDP growth for 2022. That's down from December, last time they did this plot, when the Fed was talking about 4%. Or you go down a little further to inflation. Today's inflation is higher. So they're saying end of 2022, we're looking at 4.3%. In December, they thought it would come down to 2.6. The last one is their read on what the federal funds rate, the short-term interest rate that the Fed funds set, and they're now talking about 1.9% by the end of 2022. In December, they were talking about 0.9. All of this is a kind of depressing picture if you compare where the Fed thinks we are in March to where they thought we were in December. That we're talking about lower economic growth for 2022. We're talking about higher inflation by the end of the year, and we're talking about more interest rate increases. Right now, the Fed is really talking about, and the market is pricing in, about 7 interest rate increases during the cycle before we get some kind of peak. You know, it's still, we were so low, been so low for so long that even if we get 7 rate increases of 25 basis points each, at the end of those raises, we're looking at only about 2% on the short term. But one of the things that's really additionally troubling is that the reaction of the bond market to the Fed. Now, one of the things we like to watch is something called the yield curve, which really traces the difference between the yield on, say, 10-year treasuries and 2-year treasuries. And normally, as you'd expect, the yield on a 10-year treasury is higher because people say, well, I'm going to lock up my money for longer, so I want a higher yield. An indication that the economy and potentially then the market is going to get in trouble is when the gap between that short-term interest rate, that say the 2-year, which is very sensitive to Fed interest rate increases, and the 10-year starts to shrink. When it gets to the point where the yield on the 2-year is higher than the yield on the 10-year, it's called an inverted yield curve, and it's an indication that people are saying, hey, I'm seeing that the yield on the 10-year should be lower because I'm forecasting a recession. Right now, we've got the yield on the 10-year treasury is 2.22 today. That's up 7 basis points from yesterday. The yield on the 2-year is 1.99. That's up 14 basis points from yesterday. So you can see that the 2 years climbing faster than the 10-year. Both are up on the Fed's action today, but the gap is shrinking. And as that gap continues to shrink, you can expect the market to get more and more worried about the possibility of a recession. Thanks for watching. This has been Jim Jubak on my YouTube. If you want to give us a thumbs up, please do. If you want to subscribe, so that way you get notification of when we're doing other videos. We do about 3 a week. Subscribe to the channel. If you want to see more of my print stuff, my words without me talking, you can go to my free site, jubakpicks.com, 3 portfolios on that, or you can go to my subscription site, jubakam.com, and that has 6 portfolios. Thanks for watching.